finance. So it's a unappreciated story, and we need to make sure we celebrate that a lot more. The reverse is also true. When I talked about we created digibank in India and then took it out all over the world, that reflects a couple of really important things. India's ability, the talent base and the tech capabilities are really exceptional. And so that you can actually take that and engineer and drive a lot of stuff as you go out into the East. We've been able to do that in our own case. And therefore, we need to recognize and appreciate that story. That's the first part. Now, to your specific question, the way forward, I'm just so bullish on the opportunity we have for 2 or 3 reasons. Number one, everybody knows India is the story of the moment and will be the story for the next several years, decades maybe. A lot of Singapore's capabilities and strengths are well aligned to be able to participate in that India growth story. You asked which sectors. You think about, we talked about AI, machine learning and technology. Now, India has some strengths, so does Singapore. Energy, it's a big deal for India, 500 gigawatts of renewable energy by 2030. Singapore is a champion today in renewable and green finance. So there's an opportunity for us to co-construct, co-create, including moving down up the value chain, things like hydrogen and so on. If you look at infrastructure, continues to be a big need in India. Singapore, I mean, everybody knows infrastructure. Singapore is great, but it's not just because it's small cities. Singapore has capabilities. Public housing, for example. I think there's a huge opportunity over there. Water, going to be a big crisis in South Asia and India. Singapore has mastered water. So there are fields in infrastructure that Singapore can clearly participate in. And a source of capital. It's a small country, but we have over $1 trillion in reserves, and we are consciously reallocating capital across the spectrum. So that's a big opportunity. The reverse is true. India's always had a look-east policy, now act-east policy. But for the first time, I can see that India is actually focused on both sides of the supply chain and looking at Asia ex-Japan ex-China quite seriously. One is on the sourcing side. As you think about Viksit Bharat, the best way you get Viksit Bharat is to plug into Asia supply chains. And that is something that is already beginning to happen. The geopolitics helps, and because of geopolitics, all our clients, for example, the Koreans, the Taiwanese, everybody from Asia, the Western multinationals, are all looking at creating an additional layer capacity in India. So that's a huge opportunity for India to be able to attract a lot of this supply chain work. But equally at the tail end of the chain, for the first time, Indians are beginning to think about global brands. And many of these global brands would play extremely well in Southeast Asia. People don't realize, but you think about Indonesia. Do you know what the word for a 3-wheeler auto rickshaw is in Indonesia?
Tuk-tuk.
Bajaj. Do you know why Bajaj is Bajaj? So Indian Godrej, it's got a lot of brands in Malaysia and South. So Indian brands, actually, the price point and the brand positioning is quite good. So there's an opportunity for India on both sides, the sourcing procurement side, but also the distribution and sales side. So I do think because of the alignment of interests, the nature of geopolitics, the massive growth, Singapore doesn't have a natural hinterland. And therefore, the ability to build this connection is actually very, very interesting for both countries.
Okay, time for a short break, but a lot more news and updates on the other side. Stay tuned. Welcome back. Well, for the markets, holding up well. So we have the mid-cap index, which is up around 0.7%. A couple of these stocks which are doing well include ONGC, which is your top gain on the Nifty. It's up around 4.6%. And along with that, a couple of other stocks such as SBI Life as well. But on that note, we need to wrap up on the show. But stay tuned. Closing bell up next.
The Taiwanese index is down around 0.2%. The Hang Seng is down 0.6%.
Companies reported a revenue decline of 1.6%.
If you look at it, earnings estimates have changed only between 2, 3, 4%. That's it.
The net of this is probably it helps Trump in the polls.
The Nifty is starting at about 24,573. It's a new high, of course.
Clearly, if you look at the markets last 3 months, the quality factor has done well.
The budget comes against the backdrop of an impressive tax revenue.
For the last 30 minutes, have been positive for our markets. We're up close to about 75 points in the Nifty.
Singapore's investments in India are well north of $100 billion, probably close to $150 billion.
It's almost there. 3.4% is the inflation.
Markets, for now, it's buoyant. We have seen both the Bank Nifty and Nifty.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Okay, it's a good-looking screen once again as we begin this new edition of Closing Bell this Monday afternoon. We are coming to you as always from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant, with me my colleagues Reema and Surabhi. Guys, hi, good afternoon.
Hi, afternoon. Well, new records is always a great way to begin the trading week. And the Nifty has just done that. And it's managing to hold on to 24,600. So that's another tick mark, another milestone ticked.
Absolutely. Green is the color, right? And today we can't even nitpick and say that mid-caps are not doing well or banks are not doing well. It's pretty well-rounded, the screen.
Yeah, no, absolutely. And, on Friday it was just IT, right? I mean, just IT.
Yeah.
Everything else was down. It's maybe a little more broad-based. Actually, IT, if anything, is down. The IT index is down about 1/3%. Actually, Friday's move was surprising. I mean, at least to me, it was a little surprising. The way stocks all rallied because, very minor upgrades to earnings, etc. But I think there are other factors at play. Top of the list of factors, of course, is trying to find new ideas, trying to find sectors which have not performed with some trigger, and I think the market is latching onto it. Of course, there are, there's under ownership and U.S. rates which have come off, which are expected to come off even sharply. So all of that is there, but I think today, of course, the index is down 1/3%, as I said. The sector which is doing the best is the PSU bank index. It's up 3%. But as I said, it's a little more broad-based because you've got the oil and gas index, which is up about 1 3/4. You've got the CPSE index, which is up 1.4. Real estate is up 1.4. Pharma is down 1.3. Pharma is up 1.3. Energy is up about 1%. So, I mean, I can count about 5 or 6 indices with over 5% gains, and and one index, the PSU bank index, with gains of over 3%. Lots of individual stocks in the broader market which are seeing a lot of action, which we will get to in just a bit. Reema.
Well, let's get to IT. HCL Tech is still holding up in the green, though it's come off from the highs. In the morning, it was up 3.5%, 4%. Now it's just about up 1%. But the rest of the IT pack, so LTI Mindtree is under pressure. In fact, I think LTI Mindtree is the top Nifty loser today, and that's down close to about 2%. But even other names like Wipro, TCS, some of that build-up that we had last week is coming off today. So LTI Mindtree is under pressure, but even the other names are seeing some amount of weakness. But outside of that, you've got PSU banks doing well, led by State Bank of India. The Nifty oil and gas names, so ONGC, GAIL are higher in trade. But as a basket, it's the CPSC. Club it together, and all the PSUs today are higher in trade.
PSUs are doing well, but even non-PSUs in the broader market, mid-caps, small caps, there are big moves out there. Look at a stock like Godfrey Phillips, surging almost 16% now as we speak. There are other names. There's an ITD Cementations, a Tanla platform, 6 to 7% higher. Big moves coming in. HPL Power Systems, 10 to 11% higher. So it's a very vibrant screen. And within the PSU basket, IOB really catches your attention right now, about 8% up on that stock. So looking good. Plenty of names. Nucleus Software, plenty of names on the upside of the screen as we see things. So the question is, how do you position yourself in this last 1 hour? Which are the bets that perhaps you could be looking at? We've got Mitesh joining in with some ideas. Mitesh, good afternoon. Good to have you on. So what bets? What would you go with now for the last hour?
So good afternoon, Surabhi. One, the directional bias remains on the long side. I think there's no doubt with that. The Bank Nifty, which was slightly underperforming, has started to participate as well. And therefore, I think it's not a bad market to trade on the long side. And the Nifty IT is cooled off slightly, but I think the overall bias is on the positive side. So one trade on the long side. Two, I think, on the stock side, I think SBI and About India are on my list. About India, I think, is showing a good candlestick pattern as well as indicator setup. So would recommend to buy here with a stop below 28,300 and target of 29,200. And SBI, with the banks doing well, SBI is leading from the front. That's a buy with a stop at 867 for targets of 910.
Okay, those are some trading ideas. Nigel is also with us, joining us from the newsroom. Nigel, what catches your attention?
Well, that's right. ITC, that's clearly the one that's come back, and it's been a big underperformer. After the recent 10% move that we have seen just in a matter of around 2 weeks or so, ITC is the stock that's really come back. And if you just pull up a 1 month chart, actually, you'll see that move from around 420 all the way to around 465. But if you pull up the last 1 year chart, well, the stock is actually unmoved, while its peer set has rallied 10 to around 20%. So what the street is factoring in right now is that no rate change or no kind of tax tweaks that we'll see on cigarettes in the upcoming budget. And if that's the case, then they're already factoring in a bit of a catch-up. Valuation-wise, it's always in their favor, in ITC's favor. So that could be some of the reason. That's really the stock that's come back and supported the Nifty. But let's focus on another theme that's been in focus today. Your tire companies, they have announced, price increases. Sonia joins us to fill us in with a quick analysis on that. Sonia?
If you look at it, there has been a price hike across the board for most of these tire companies. And the one that we're looking at this afternoon is MRF. MRF has announced a price increase effective 18 July. Truck tires have been hiked by approximately 2%. Passenger car and radial tires prices have been hiked by in the range of 3 to 7%. So far, there's been no hike in two-wheeler tire prices, but the blended price increase works out to be about 2%. Now, this is the first price increase that MRF has taken in order to pass on the higher raw material costs to consumers, specifically rubber and crude that is used in the manufacturing of tires. Now, if you look at it, the other players like Apollo, Seat, JK Tires have already taken approximately 3% price increases, and the price increases still lag the cost increases that have been seen in the last 3 to 4 months. So, despite the prices being passed on to consumers, there could still be some margin pressure that the companies face because of higher rubber and crude oil prices. So overall, yes, it's a positive for MRF, the fact that demand is strong enough that they were able to pass on the price increases to customers. Back to you.
Well, big rally going out there in tire stocks today. Sonia, thank you very much for that. HDFC Life has been gaining. The company has reported 15% jump in its net profit year on year. We've got Yash with the details. Yash.
Well, Surabhi, if I have to summarize the numbers for HDFC Life, it's a strong top-line growth with the new business premium and annualized premium equivalent. But margins have sort of come down more than what the street was anticipating. So I'll start with the top line itself. New business premium, there's a slight miss when it comes to our poll. We were anticipating a number of 6540 crore rupees. What has come for us is 6400 crore rupees on the new business premium, though it's a 9% increase on a year-on-year when it comes to that particular parameter. Total annualized premium equivalent, it's ahead of our estimates by about 100 basis points, coming at about 2866 crore rupees. Our poll was 2846 crore rupees. It's a 23% jump on total AP on a year-on-year basis. Retail AP also is ahead of our estimates by about 50 basis points, coming in at about 2467 crore rupees. Our poll was 2453 crore rupees, and there it's a 31% increase when it comes to a year-on-year comparison. Value of new business is the point where we see some weakness starting from. So it's down 2% from our estimates, but a growth of 18% still on a year-on-year number. And finally, the margins seems like the growth in the ULIP portfolio was larger than what the street was anticipating, and hence the margins have come down a bit. So they missed our estimates or the street estimates by about 64 basis points. The margins have come in at about 25%. The street was anticipating a number of about 25.64%, and on a year-on-year basis there's a further erosion down about 120 basis points at 25% versus 26.2% on a year-on-year basis. Margin was one thing which the street was looking at very closely. If they would have been upwards of 26%, the stock would have taken off in a very strong way, because the valuations are very supportive for the stock at this moment. But margins have come down a slight bit, and hence the stock hasn't moved from where it was before the results were announced.
Okay, thank you very much for that. Hemang Jani is now with us. Hemang, first come in on the tire stocks, big up move. So as Sonia pointed out, it's still playing catch up to the kind of raw material price increase we've already seen. So it's not that it's going to reflect in the margins with a big, bump up in terms of a margin increase. What have you made of the kind of, price rise in all these stocks?
So surely, the market was expecting some price increase because of the way the raw material prices have increased in the last about 3 months or so. But surely, this news has come as a bit of a positive development for the sector. And when you look at the companies, Apollo Tire, Seat, these two companies have a slightly better correlation with the product mix that they have in terms of the passenger vehicle and the CV segment. So I think they are relatively better placed. And apart from that, Balkrishna Industries, the news is that the actual price increase that they have taken is slightly on a higher side, about 5 to 6%. So these are the three companies that we prefer, not just because of the price increase, but because there is going to be a certain degree of growth in terms of EBITDA and EBITDA margins both in this quarterly numbers. So considering both these things, the quarterly numbers and the price increase with correlation to their product, I think these three companies are better placed.
Okay, all right, Hemang, hold on to that thought. Let's focus on Zomato because if you're ordering in, well, there could be a bit of a hike in your platform fee. Well, Mangalam joins us to explain all of that to us, explains why the stock is making a fresh 52-week high today. Mangalam.
A mild hike in your platform fee would amount to just about ₹1 increase in your overall bill, but it would mean a lot more for the company's EBITDA, and that's exactly what the company is playing for. And the stock is reacting to that. So the food delivery platforms have actually increased their platform fee, which is Zomato, in their key markets, key metros, from ₹5 to about ₹6. This was introduced way back in 2023, and from there, it has been increased, and it's also dynamic in nature, where on important days like New Year's, etc., it's gone all the way up to ₹9 to ₹11 as well. But what this basically does is this ₹1 increase in platform fee. If you're assuming they would do around 85 to 90 crore orders this entire year, then maybe it would increase their EBITDA by about 85 to 90 crore rupees, which is about 5 to 6% increase in their overall food delivery EBITDA. Morgan Stanley believes that it could aid their contribution margins by about 20 basis points as well. But this also needs to be looked at in connection with the cuts that they've taken or the discounts that they've given on Zomato Gold memberships. So those are a couple of factors that we'll have to watch out for. They have an overweight rating with a target price of 230 on the stock. As per Elara is concerned, they're saying that maybe there's a 5 to 6% jump in the EBITDA, but the geographies that these companies have actually gone ahead and increased the platform fee in would not account for more than 1 to 2% of their overall EBITDA increase. So as a result of which, it is a step in the right direction, not to the tune of 5 to 6%, but a positive step nevertheless. But importantly, the other optionality of Zomato, which is the high growth that we're seeing in Blinkit, along with the possibility of that turning EBITDA positive very soon as well, is something that the street is excited by. And that's why we're seeing that big move on the stock. From the lows, it's rallied to a record high that we're seeing today.
Thank you very much for that. We were chatting with Karan Tarani, and he pointed out how quickly the platform fees have increased. So last time they were introduced for the first time in August last year. In April it was, it started with 0 to 2, then 2 became 4. In April it became 4 to 5, and now we've seen a price increase to 6. And he's like, you won't be surprised even if it goes up further to 8 or 10 rupees. But they're doing it in a very phased, gradual manner, without it pinching any consumer's wallet. So even in the past instances when we have seen a platform fee hike, it's not that demand has been impacted. And his target is that by the end of this year, fiscal year, adjusted EBITDA margins for Zomato should hit 3.7%, and the following year we could get to 4.5%. That's FY26, which is within the company's guided band of 4 to 5%. Hemang, comment on Zomato?
Clearly, when you look at the increase in the fees to the extent of 20%, the sensitivity to their operating profit is almost about 6.5 to 7%. Also, if you adjust for the discount that they are offering, the eventual growth would be in excess of about 7.5% when it comes to operating profit. Also, the Blinkit side, the company is doing exceptionally well. So of all the platform companies that you have, there are very few where you can have that kind of a conviction where you will see a decent amount of growth, in terms of transaction value, in terms of operating profit. So surely this is a stock that, is one of our top picks within the platform, company as a theme.
Okay, got that, Hemang. Hemang, just earlier we were discussing this price hike in tires. Sonia was telling us about the details, and it's got tire stocks fairly excited. What's your sense? I mean, is this just a bit of an excitement or because of this price hike, or do you see some value here? And which ones do you like?
What we feel is that the price increase has been taken on the CVs and passenger vehicle. The two-wheelers are left out. And when you look at the companies, the Apollo Tyres and CL, these two have a slightly better product mix, which will have a better sensitivity to the operating profit growth. So these are the two names that we like, and Balkrishna also we prefer at this point of time. And though in the news this is not featuring, but the actual price increase that they have taken is slightly in excess of 5%. So these are the three companies that we like, not only because they have taken a price hike, but also from a quarterly results perspective.
Okay, all right, Hemang, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here, and I really appreciate your time on CNBC TV 18. You know, we'll take a quick commercial break here. We'll come back in just a bit from now. I just want to quickly sort of put out a programming note for you. This is for this Wednesday, which is the middle of the week and also a market holiday. We're getting you a special offering. A big CNBC TV 18 exclusive just ahead of the budget. One of the world's top market strategists is going to be in our studios. Chris Wood of Jefferies will make his bull case for India. Don't miss out on an exclusive chat between Chris Wood and D Street stalwarts like Ramesh Damani and Utpal Seth this Wednesday at 9 a.m. only on CNBC TV 18. Welcome back. 93 points higher. We're at 24,600. I mean, give or take. So looking very, very solid start of the week. Sandeep Tandon is now joining us, founder and chief investment officer at Quant Mutual Fund. Sandeep, great to have you back in the program. Thank you very much for your time. Prashant this side. Now, of course, unless someone has been living under a rock, I think everyone knows what has happened over the last 1 month or so, right? I mean, there has been you guys, of course, have been doing fantastically well in terms of returns to investors, AUM almost nearing 1 lakh crores. But in late June, there was a SEBI sort of search and seizure operation at your offices. And they've asked you for data, documents, etc., which you've told your investors and in other communication that you have provided. So I have to start by asking you, because, I mean, I think your journey has been propelled by retail investors more than anything else, right? And I think they have the right to know what is happening with this SEBI sort of investigation, what this is about, and where is it at?
Prashant, when it comes to regulatory aspect, there's a policy, and we generally don't like to comment on that. Whatever communication was required, we have already communicated. Since this matter is still investigated, so we'll like to any comment on that part. As and when any development happen, we're happy to share that for time.
But Sandeep, just to sort of press on that point a little further, I think the concerns emanated from reports that were indicating that, among other things that are being investigated, there could be a possibility of front-running that the regulator was also looking into. Can you just share the gist of the FAQ? I know there's an FAQ that you folks put out in public domain, but what is your official stance on this right now?
Official stand has been communicated. As I communicated, will not like to comment beyond that, because as a matter of investigation and regulator is looking into it, we are cooperating with the data. And beyond that, we will not like to really comment. And whatever comment was required, we have already given in the public domain.
Is there a regular back and forth in terms of demand for data? I mean, the first...
Prashant, I was very candid with you. We will not drill too much on this subject because it's a regulatory matter and we don't like to. Let's focus on our businesses as usual. Let's focus on what you called me for market perspective rather than getting into other tangent.
Okay. So let me ask you, just one last, before we tie this off and move on to markets, has all of this made any impact on your assets under management, or what? Give us a sense of how that has moved since
Not
this came
really,
through.
Yes, obviously, it obviously any such noise will have a psychological impact. Answer is yes, but beyond that, not much. Life is as usual because we are putting our effort, whatever we are known for, generating alpha for our retail investors, and we have been practicing a very dynamic style of money management last many years. And last 5 years, you have seen that we have been one of the biggest outlier in the industry. Okay, and this is something which is possible. The new thought process, new analytical skill set which we brought, and we're talking about how instead of looking at just the stock specific data, how we as a house we are a student of adaptive asset allocation, how from very deep macro we come to micro level. And we have demonstrated in generating superior risk-adjusted return when they look at 1 year return, 3 year return, 5 year returns. And the outperformance is obviously very good. But what gives us satisfaction is the risk-adjusted return. A lot of people perceive the quant is a high-risk house. Actually, it's not, because our risk-adjusted return is one of the best in the industry, which means we have taken less risk and generated more alpha out of it. That is something which we are very proud of. And this is something which we educate people, This business is all about risk management. We say very proudly, we are in the business of risk management, returns are byproduct. If you manage your risk, whether it's known risk, unknown risk, perceived risk, or any type of risk when you talk about, if your handle on the risk is good, you will able to come out of any event which plays out. Let's say unknown risk played out last year. If you recollect, unknown risk was there and we were affected party. But look at from the last quartile to effectively number one position, we came back in 3 quarters. So that is a very important how you manage a risk. You will face risk, but managing risk is a very important aspect. That is
got it. And AUMs are now about north of 94,000 crores, right? One of the things you said risk so many times. One of the risks which, and I'm sure you've heard this many times as well, so it's nothing new that I'm telling you, is that, it's seen as a one-man operation. It's Sandeep Tandon. So there's that, in that sense, there's a key man risk, right? And it's very important. If people invest on the back of who's the fund manager, and of course who's running the house. So just a quick sense. Are you expanding the team? Are you broad basing it a little bit? What's going on?
So I'll answer this thing in a slightly different manner. First of all, yes, if you have to understand, it's not one man show out here. It has been institution framework, and you have to also understand it has been a startup type journey. The only difference, we have been now proven as a successful startup in this space, and we have able to create an asset light model with limited people, with no branches and limited manpower. We are able to scale up this business purely on the background of performance and system. That's very important to understand. There's a process behind that, what we have built. If you really look at in last 6-8 months, we have added so many people on the operations side. Head operations come, group CFO has come, whole-time director is joining us. We are adding people on the board also. So we are expanding team. You look at the biggest challenge as a house which we have faced, in that we have grown much faster than the organization. Okay, so we never felt that we will grow like this manner, which has actually happened. But in last 6-8 months, we have put in efforts in substantially adding our offices, or we are looking at new team members. Senior people have been getting hired. So that's the way the journey is all about. We have built. But now let's look at the global perspective. When it comes to money management, it's about individuals. Okay, money managers globally, individuals are more successful than the institutions. Okay, because this is a very individualistic trait. It's a very it's individualistic art. So what we are trying to create very uniquely at Quant is all about a analytical framework. How, from a traditional style of money management, we are bringing an analytical perspective, which at least I have been doing for a while, and my team is doing with me for a long period of time. For nearly Quant Global Research exists from 2007-8. So if you really look at a reasonably long journey, and I'm myself in the market for 33 years, we are doing this sort of behavioral research or quantitative research or qualitative aspect research. So we spend very sizable money on in terms of data analytics, and that has paid off. A lot of people don't understand what we do. A lot of people perceive a risky house and they run some black box. No, we are very high-end process-driven house. Otherwise, this sort of outperformance is not possible across all the schemes, all the categories which we operate. We are actually #1 quartile fund house in most of the categories. Only possible when you have processes around that. You have system built around that. So it's not very fair to assess that's the one-man show. The processes, who built process? Not me alone. My team has been working for a while on this thing. For over years, we have built something. It's not something which is built in last 2 years. We have put in efforts for last 15 years in building Quant, what you see in today's form.
Analytical framework. Can you tell us what it throws up in terms of the next big, bold bet for Quant Mutual Fund? You were early investors in railway, infrastructure, even the consumption fund that you launched before market recognized it as a potential theme. So what are the big bets now that you're making, and what is the call over the next 6 to 12 months?
So, as you rightly said, being a part of predictive analytics means we are able to identify these inflection points much earlier than the market. Okay. Now, even I will only highlight that last 1 year, we are hearing about big market voices talking about quite bearish about India. Even most of the FIs was quite negative, but look at the market is keeps on making new high and high. Okay. With that background, I just want to highlight two important observations. If I have to look at from a global perspective first, and then coming to globally, I'm seeing some sides of complacency coming, particularly the US market is becoming slightly more complacent. If I have to look at the complacent indicator, is actually has spiked a lot, which is some amount of worry sign for the US market. I'm not saying they have made a top. What we are trying to say, the complacency has set in. Whenever this scenario comes in, we turn slightly cautious. So we are talking about that partial risk off phase for the developed market, and risk on rally continues for the emerging market and India in particular. So with that background, if I look at if I have to bring the second dimension aspect on the liquidity aspect, if I have to talk about the global liquidity towards money flow analytics, if I have to work on the global equity is actually rising quarter on quarter, month on month, on year basis. So which is a very healthy trend, and something similar which we have seen in not only India, it's a global phenomena which has played out quite well. So that's the liquidity background is very constructive. Yes, valuations are partially stretched, and that's the reason we always say sector rotation, stock rotation, what we call it money flow analytics. That is something which we specialize. That really help us in managing a risk better instead of exiting from the market.
Right. Hi, Sandeep. Good afternoon and good to see you. And, when this entire fiasco that broke out, you had, two sides of investors that were looking at it. One was already invested. They were wondering what to do next, who were already part of Quant Mutual Fund. And the other part was they were saying, hey, there's some bit of uncertainty. It's a good time to get in. So that's the kind of feedback that I personally got as well with regard to this entire fiasco. But let's talk about the cash levels. Now, I was looking at Quant Mutual Fund and the cash levels all the way from January. It seems you'll have raised some cash, ahead of the big event, maybe. I think it was at around, it's currently at around 5%. You could correct me on that number. But your view on current valuations, we're getting into a big event, which is the budget. Have you all raised some cash levels, and are you all comfortable currently?
No, Nigel, the way we look at not only now, we have changed our strategy from January 2024 onwards, when I have been very vocal on multiple channels. And we have been educating investors that easy phase of bull run is over in India also. Okay, again, don't misinterpret. When I'm saying the bull run is over, it's an easy phase. We are in decisive bull run, and within decisive bull run, we are in difficult phase of bull run. So your strategy, when you're talking about a difficult phase of bull run versus easy phase of one, has to be different. So last 6 months, we have actually moved out from an illiquid stock to liquid stock in our portfolio. And this is something because we have seen how the impact cost in the market has risen in last many months. Whenever we see this sort of phenomena, it is very important to have your portfolio to be very liquid. That's the reason it's not about particular budget events, which is now knocking our doors, or the election related aspect. It was more of a data driven approach, which forces us to take certain steps. So purely on an analytic basis, we were trying to play this game, but we have not raised very large cash. See, when you manage money in a very dynamic manner, depending on the situation, we do increase our cash level and we do deploy also. So as of now, also our cash level is actually on the lower side. Okay. But when we say cash and cash equivalent is on a higher side, because majority of our portfolio is towards large cap. That's a one big change which we have seen in last 6 months, that our portfolio, overall portfolio, anyway, quant scheme has hardly 15 days exit load, which is insignificant. So when we design our portfolio from a longer term or medium term perspective also, we do give a lot of weightage on the liquidity analytics. And if you have seen our Realty framework, liquidity analytics plays a very big role. So we do understand the impact of the liquidity and the prevailing high impact cost. Based on that, a mild risk-off environment which played out in the developed market, we have rebalanced and reconstructed our portfolio in a dynamic manner.
All right, Sandeep, thanks for clarifying on that. But we're still in a decisive bull market. That's the takeaway that I got from that as well. Now, I have to ask you about the PSUs, because you all were in very, very early. And you all, played the theme perfectly, whether it was the metal PSUs or the other PSUs as well. Yeah. How are you all placed currently? And if you could tell us, if you all have sold anything from what you all have in the PSU basket, because some of them are already up 3-4 times.
So, Nigel, the way we manage our money is a very sector rotation, stock rotation is part of our philosophy. That's the way we manage our overall money management skill set is there. So whenever we see some sector or stocks are moving towards a euphoric phase, we tend to prune down the exposure. And when we say they're in the neglected and beaten down or the most hated zone, we all in. That's the way we do it. But if you ask me, given the bull run which we have seen last 3 years, there is no sector or space where we can say except media, which is in the completely neglected phase. Okay, so it's very difficult to pinpoint extreme hated zone right now, but we do get such opportunity, not at the extreme neglected side thing, but when you do get into a partial neglected. So again, it's a relative term. You don't look at everything on absolute basis because relative is equally important. When the market overall has risen a meaningful manner, then you will not get extreme neglected territory. You will get even partial neglected territory. Those are the areas we do capture. And that's the reason when you talk about metals, we are very early. Consumption theme, we were very early. Pharma last year, we were very early. This year, with the consumption is a big play. We still believe that consumption as a thesis has more legs to go and is grossly underowned stocks. This is the area where a lot of people got stuck in the past. And we have seen a capitulative move in last few months. And that is the ideal scenario where we increase our exposure. So that's the reason across the board, if you look at our portfolio, right from November, December, we have been adding consumption names in a big way.
Sandeep, just to take off on that, when I was coming to exactly this, the core of your stock selection philosophy, I was looking at the latest fact sheet, for instance, and 3 stocks, which is HDFC Bank, Reliance, and even a Jio Financial Services, they make a large chunk of a lot of the different funds. They're the top holdings in the small cap fund. They're the top holdings in the flexi cap, and even in the small cap or some of the other funds as well. So. And I also track personal finance, so we did a show on the fundamental behind the quantitative method. Now, each fund house that has quant funds, they follow their own algorithms, right? And they could be based on different factors, whether it's momentum or some people combine quality with momentum or value with momentum, etc. So you just said that you like to own the unloved side of the market. So for your investors and for viewers who are interested in quants funds, could you just summarize what forms the core of that algorithm that you are following in terms of factors, top investing styles, or the methodology itself as it stands right now?
So let me just clarify, we don't run any algorithms out here. We are not just a quant house and we don't follow any factor-based thesis because we are actually quite critical of factor-based thesis. That's a very static style of money management. This much growth, this much momentum, this much value. That's not the way. When we talk about ourselves, we are unconstrained fund house. we are style agnostic, market cap agnostic, thesis agnostic, we are pure opportunist. So when we talk about pure opportunity and wherever we see get superior risk-adjusted opportunity, we play that thing. Our strength comes from the background that we combine qualitative, quantitative, and behavior aspect. And that is the strength. So 1/3 weightage is given to the each segment. So if you look at our VLRT framework, 1/3 weightage to the valuation analytics, 1/3 weightage to the risk appetite analytics, 1/3 weightage to the sentiments data, okay, or the risk appetite, valuation analytics, and the liquidity aspect. And T is the timing as an analytical tool, not the timing. So timing is the analytical function of all three. So when you see skewness on one side, we do take very aggressive bets. Let's say example, I'll explain in the morning also. Like if you've seen last year, we have very high level of ITC in our portfolio. It's a public domain, the way you've seen that was currently like Reliance or HDFC is there. But few months back, we offloaded and we shifted towards Reliance. And that played out very well. Reliance is up 50-60%. ITC is down 30-35%, from the peak. Okay, this rallied recently. That's a different issue. But we got the benefit of that. And something similar a few months back when we saw there were some challenges in HDFC Bank, and some negative development was there. We were the first to exit. And when we spotted that HDFC hit the neglected territory, the hated zone sort of thing, partial hated zone, because we are in bull run right now, we are as an opportunist, do capture that opportunity. As I explain always, we don't have any affinity, hated sort of relation, love and hate sort of relationship with any sector stocks. We are pure opportunists. Whenever data point changes, when I say data points, whenever we see inflection points, so we as a house is more known for as inflection point strategies rather than a lot of people consider as a momentum thing. When we see extreme inflection points in either way, we are as an opportunity try to either build or exit those positions.
Got it, Sandeep. And right now you're saying we're in the difficult phase of bull run, so there's no real big hated sector, right? Which market hates. So
except media. Except media is still one of the sector which is massive.
So anything you bought there, Z or something? Or anything?
No, if you really look at our portfolio, you will get the last fact sheet, the Sun portfolio, Sun TV portfolio. That's the one stock, is there in the fact sheet. Generally you don't comment on the stock, but if you look at our fact sheet, you will get that answer. That's the exposure we have built across some of the schemes.
So for your investors who may be watching as well, if you are in a difficult phase of bull run, should they also moderate return expectations a little bit? Would you guide them to it, or you think it's yeah?
So, Prashant, since we are not looking for marketing perspective, I'm a very candid and vocal person. I think it's a India opportunity. So I think we always say this decade belongs to India, maybe half century belongs to India. Every forum we go out on saying don't exit the Indian market. One of the lifetime opportunity you are getting. Okay, so best way to play through some of the mutual fund, which we manage in a very dynamic manner, sector rotation, stock rotation. That's the way to play this game. One should not exit. And if you've seen that last 1 year where we have seen this narrative market peaking out, something absurd happening, all those commentary or the people who have made comments, actually they have suffered. Okay, in last 1 year, they exit. And now you are not able to participate. It's a psychological game. You are not able to get entry again because market has rallied 40-50% after that also. So that background, we will not advise anybody. Yes, one should assess your risk appetite on continuous basis. One should assess your investment horizon and accordingly shift the sectors or the schemes or the money managers or asset classes depending on the outlook if you can analyze on your own.
Got it. I mean, exit, of course not. My only question was about return expectations because it's been extraordinary last couple of years, and maybe it will be extraordinary in the next many decades as well, as you point out. But
so again, if you have 5-year horizon, then returns will be extraordinary. Even in small cap, returns will be extraordinary. If somebody has only 5 months horizon, that is the area where I always say you go and back and check your risk appetite and investment horizon. Then your scheme has to be different if you have very short-term horizon.
Short-term. Got it. Sandeep, we'll leave it there. Thank you very much. Great speaking with you. Appreciate you joining in and all the best to you and your team at Quantum Mutual from all of us here. Thank you. We'll take a break. We are back. We'll get you a quick check on what's happening in dealing rooms. D Street Chatter with Nimish coming up in just a bit.
Welcome back. You're tuned into Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, the markets are holding with gains, but from the top, the Nifty has slipped close to around 50 points or thereabouts. Still up 75 points, but at the high of the day, we were up 130 points, which is a good time to get in Nimesh, who helps us out with D-Street Chatter. Nimesh, it's still a good session.
Yeah.
Breadth of the market is still positive, though those lines have narrowed a little bit. But how are you reading this?
But Nigel, today's day is purely for the broader market stocks. Like the mid-cap indexes are up almost 1%. So after one and a half weeks of consolidation in the broader market, today there is a bit of interest back in that space. So it looks like the start of the week is largely on the mid-cap and small cap. Having said that, the flows are quite muted. So the larger flow seems to be in the large cap names in the last many days. But today seems to be a muted day. There is lack of participation, is what I understand. The only space which has seen some bit of buying interest, especially from domestic mutual fund, is IT for the second day running. We saw a big rally on Friday after TCS numbers and Infosys numbers, but at least that momentum in buying into IT stocks continues from the domestic side. The other sectors which have done well, relatively well today, tires have done well. I'd spoken about a possible hike from MRF, and that's at or above on the entire tire space, so to speak. Pharma has done selectively well. There were some news-based reactions as well, and also some select PSUs is back in action. So that space has done well, but not much from the larger institutions overall. From a trigger point of view, I think earnings is going to be a big trigger. That's going to have an impact on individual names. But now everybody is watching out for budget. So it looks like the lack of participation is because of the budget down the corner. There's a bit of caution, and they just want to get out of that way, and then probably they'll commit more. But the momentum in the broader market seems to be, at least that looks like for real, at least in the short term.
Okay, all right, Nimesh. But let's get to individual stocks then, since the broader markets are in focus. What are the news bits you're picking up on individual stocks?
Well, the first is the large cap name ONGC. That's been a big mover. In fact, it's seen a bit of a technical breakout as well. And I understand some larger HNIs are quite active in the last many days, and hence a big move in that stock. So that's the first name. The second stock is Pearl Global. This is going to be interesting. 730 odd stock. There is a large block as well, 2.5% equity. And after that, you've seen a sharp recovery as well in that stock. I understand some domestic mutual funds were buyer in today's block deal. And additionally, the company is likely to raise funds via QIP very soon. So that's the reason why you've seen some bit of action in Pearl Global today. The third stock is Macrotech Developers. Again, a big move in that stock. The volumes on the higher side. Large part of today's pullback is largely because I understand the selling pressure from a leading FI fund is largely over, and some domestics have started buying again. So that's the reason why you've seen a big move there. And the last one is Onward Technologies. That's not something which you talked up too much about, but it's a decently institution-owned stock. It looks like some bit of interest is back from larger HNIs, and that's the reason why even that stock is buzzing in today's market.
Okay, all right, got it. Nimesh, thank you very much for that. So those are a lot of the stocks that are on Nimesh's radar today. With that, let's get back to some trading calls. We've got Mitesh Thakkar with us. Mitesh, what are the additional stocks you're looking at?
I'll go with the BTSC and Bajaj Auto. I think that's had a good reversal and is consolidating near the day's high. So keep a stop at 96.40, look for a target of 97, 30, 35 to begin with, maybe even higher levels, but that's the initial target. And that apart, I think, BTST on Bajaj Finance, which is reversing after a correction actually. So we'll take a very tight stop at about 70, 40 and look for a target of 70.95.
Okay, all right, got that. Mitesh, thanks very much for that. We'll connect with you tomorrow. Thank you so much for all the trading calls today. Well, with that, let's move on now. We are bringing you the latest in terms of Hyundai India's IPO plans. Sources suggest the company could make its D-Street debut in October this year. Parikshit is joining in with more details. Parikshit, this is going to be a big bang IPO, right? What's the latest you're picking up?
Well, yes, Hyundai is looking to pick up at least 25,000 crore or $3 billion from the India market via the OFS of 142.2 million shares. So Hyundai Global is divesting about a 17% stake in the Indian entity. Now, we believe that the preparation is on at a high pace. SEBI has made some observations about their DRHP, especially around the risk issues. There were about 80 risk issues that Hyundai had put in its DRHP, and the company is likely to clarify via its bankers very soon. They're looking at an IPO and hoping that they can go with the public with it in the first 15 days of October 2024. Having said that, they're also strengthening their senior management here in India, and we believe that a few key C-suite CEO-level officials are likely to be hired in the company, and this could happen before the public listing. the company is also facing some trouble from workers. In fact, the Workers' Union in India has sent a notice to the company asking them to respond in 10 days as to what benefits and compensation they are going to get from the IPO. They're actually taking a cue, in a way, from what's happened in South Korea, where the workers of the company were negotiating a wage hike and they had threatened to go on a strike. And finally, the company there in Korea has managed to come to a deal which has led to the company giving the workers the highest wage increase in the company's history. So Hyundai's workers are currently protesting, we get to know, peacefully. No disruptions in production as yet, but they want some benefits out of the IPO, even though the IPO and the DRHP does not mention worker benefits in any way. But looking at what happened in South Korea at the headquarters, the company will have to accommodate their interest. They're trying to hold negotiations with them, and the company's chief manufacturing officer is also speaking to them. Hyundai did not respond to our queries on this, but we are told that the preparations for the IPO are going on well, but the company has to somehow accommodate the workers to prevent any kind of disruption in production in the coming weeks.
Thank you very much for that, Parikshit. Midcaps continue to inch up. It's now a near 500-point rally on the midcap index. Jio Financial Services is inching up ahead of its numbers later today. And buying is emerging in NLC India, Oil India, GAIL, Castrol. So some of these stocks are seeing big 6-7% gains. Get into a break. We'll come back with more market talk.
Welcome back. Just 8 minutes till the final bell, and stocks are doing a thing of their own. V-Mart Retail was down, actually. That stock has recovered close to around 4%, and all of that just in this hour itself. That's in the last 25 minutes or so. So big move is out there. And Sunteck Realty, one of those relative underperformers. You had a large investor, Mr. Pabrai, had a large stake in there. It appears most of that got absorbed in the market, and in fact, that quarterly update was quite good as well. Mayuresh Joshi of William O'Neill joins us on the show. Hi, Mayuresh. Good afternoon. Good to see you in. What's your view on this name? Sunteck Realty didn't do much in 2023 odd when most of the real estate stocks did well. And it was underperforming. But in the last 2 months, it's come back and it's moved in style from 400 to around 600 rupees. Your take?
Afternoon, Nigel. I think, that's been a very smart move by Sunteck as well. The recent update that has come through, not really gone through the numbers, but I think the increase in pre-sales and collections have been quite robust on a year-on-year basis. Again, I think the entire construct, when you're probably looking at the real estate market, and we're probably looking at the Mumbai metropolitan region market, the MMR region as we are calling it, it has got a very strong foothold out here. So right from aspirational luxury to uber luxury, as they call it, they've got projects all around. They've also probably done the right amount of allocations in terms of whatever they need to acquire. And therefore, I think from a balance sheet construct with net debt and a very strong operational performance till date, I think it's in excess of 18 or 19%. They're also doing a little bit of their annuity income portfolio expansion as well. Which probably means that the rental incomes should probably also aid their overall balance sheet growth. So yeah, I think the numbers are probably stacking up in this entire real estate cycle for Sunteck Realty as well.
Big move, Mayuresh, today in Godfrey Phillips, 17% up, large volumes. Its year-to-date gain now stands at 125%. Anything you've picked up?
No, not really. But I think the expectation is that every time we near or head towards a budget, what probably happens in terms of the syntax. I think a large part of that has already got gestated by the market. So I think that the market is not really expecting any kind of additional burden to probably come through for companies like Godfrey Phillips as an example. But just as a cautionary note, probably you just need to look into the contingent liabilities of the balance sheet of Godfrey Phillips. They still have some payouts to be done if something does not go their way.
What about IT? Any change in your assessment about IT for the next 6 months based on what TCS, HCL Tech? Does it have a different weightage in your portfolio now? Any EPS changes?
No, not really. So I think it's still equal weight as we see it. I think we continue holding in our global portfolio a couple of these mid-cap IT stocks, Persistent, KPIT, but a clear disclaimer, these stocks are something that we have probably got at much lower levels. But looking at the commentaries, you probably expected to see, as you rightly pointed out, I think a couple of more quarters in terms of some genuine recovery starting to take place, specifically in key sectors like BFSI, retail, manufacturing, whether that coincides with the rate cut cycle in the US and globally as well. I think that will lay impetus in terms of a base case scenario in terms of the earnings recovery for the sector as a whole. Obviously, pricing in terms of how deals are expected to take place, consumer discretionary spending specifically for large million or billion dollar deals, which will impact IT companies and specifically large cap IT companies from an earnings perspective, should start taking shape. But our own take is that for a large part of this financial year, there is much of an earnings change that we are probably expecting for large cap IT. Mid cap might still continue outperforming the large caps.
Telecom has taken a bit of a break after those tariff hikes finally came through. Mayuresh, good afternoon. Idea is up about 3.5–4% today for a change. Otherwise, it's sort of fallen from the highs. What do you like in this space?
Afternoon, Prashant. So I think a large part of the move has happened with the telecom operators. I think the news has now got gestated in. And the price action already was a testimony a few weeks before the price hikes happened. So now it will go through a phase of consolidation. But yes, I think these tariff hikes will mean better operating leverage, better cash flows, and therefore better deleveraging, at least for companies like an Airtel. So I think we continue our hold rating onto stocks like an Airtel. What we probably are expected to see is something like an Indus-Star, right? Because if the action is expected to continue, we've already seen some aggressive plans happen in terms of BSNL's price cuts as well, in terms of how they are probably viewing the entire space. Our take is that Indus-Star is an example where the tenancy ratio should continue very, very strongly. Vodafone Idea's existence itself will mean that the business from Vodafone will continue. The deleveraging on the balance sheet should happen over the next few quarters as their cash flows improve. So I think one actionable that we see in terms of our EPS RS rating parameters is Indus-Star's. Bharti is something that we can continue.
Away from sectors, any individual other stocks on your radar which is making it to you, the portfolio on the long side?
Yeah, so I think we added Pennar Industries, Prashant, a few weeks back. Our own take is that the segments that they operate out of, the engineered products segment, which caters to railways, infrastructure, manufacturing, should continue doing well. Their pre-engineering business segment also should continue well. They've just commissioned a recent plant in the last week itself, but their order book is decent as far as India is concerned. Their US business asset should have a very decent growth in the next few quarters and years as well. And therefore, the management is very, very hopeful in terms of the overall consolidated EBIT margins actually moving from that 5% to 7.5% in the next 12 to 18 months. If that probably takes place as what the management is guiding for, there can be a huge scope in terms of earnings expansion that can continue over the next few years, which provides a base case scenario in terms of earnings and return ratios improving quite significantly. So Pennar is something that we're liking as a long-term focus item.
Got that. Mayuresh, thank you very much for joining in. Just counting down to the close of today's trading session, ending in the green, but just shy of 24,600. Though in the morning, the markets did go on to hit new record highs. Nifty ending 80 points up, Sensex up 122 points. Private sector financials were on the back foot. So you had a cut of nearly 1% on Axis Bank, ICICI Bank, HDFC Bank ending in the red. Though PSU banks led by State Bank of India had an up day. But the sector which catches your attention are oil and gas names. So ONGC is the top Nifty gainer, a 5% rally on that. But even the others like GAIL, Oil India rally pretty hard, and PSUs on the whole. So whether it's an NTPC, NHPC, SJVN, across the board, the Nifty CPSE index will also come up for you on your screen. So the top sectoral gainers are the Nifty PSU banks, the oil and gas, and the Nifty CPSE index. And outside of that, pharma has done well. So it's led by, I think, Apollo Hospitals is up, Dr. Reddy's, Divi's Laboratory, all closing up quite smartly.
Okay. Lots of other names as well. Some of the non-PSU names, Tanla, Godfrey, HBL Power. HBL was, of course, a big mover today. I think tire stocks Rima did mention, JK Apollo, MRF, C8. Castrol was a big mover, 7% today. I think it's at a new 52-week high, maybe a high for the last few years. Hathway did well, Sequent Scientific, Exicom continues to do very well. Parag Milk, Greenply, BL Kashyap, and I could go on with many more of these names, but a big volume-led activity in many of these names. On the downside, these actually right from the word go, some of these shipping companies, shipbuilders, they all were down. Garden Reach, Mazgaon, Cochin, etc. And I think that continued by close as well. Shipping Corporation was lower as well. But apart from that, you also had some cuts in names like Sundaram Finance, which is a large NBFC. Sonata Software was down, and HPL Electric ended the day lower as well. So, a good day for the Nifty with about